Prospector News is media for educational purposes only and should not be construed as advice. We are not a certified financial analyst, licensed broker, or fund dealer, exempt market dealer, or hold a license to provide financial advice. We provide no legal opinion regarding accounting, tax, or law issues. Nothing in this podcast should be construed as investment advice or the solicitation to buy or sell stocks or commodities. All opinions expressed are those of the participants and should not be relied upon when making investment decisions. Those decisions should be made with the advice of a personal financial advisor. If you have enjoyed our podcast, please hit the like and share buttons and be sure to hit subscribe. This is Michael Fox, and this is the Prospector News podcast. And joining me today is longtime friend and contributor, Chris Temple, publisher of the National Investor. Welcome, Chris.
Well, thanks, Mike. Always good to be with you.
So the Fed, they threw another turd in the punch bowl yesterday with another 0.75 point rate hike. That was expected, but what wasn't expected was the hawkish talk after.
Well, yeah, and that even was a shock when investors first looked at what the written statement was, which, as a lot of us expected, did finally say in writing that the Fed is cognizant of all of the rate hikes to date and the cumulative effect that they're going to have, not all of which has yet been seen. And in the future meetings, henceforth, they're going to go from being present day data dependent back to being forward looking. And the implicit message that we thought that the written statement after the meeting was done was giving us was that, okay, they're still fighting inflation. They're still going to talk and act tough, but they do realize that a point of overkill could come and maybe they'll modify things. And as a result of that, the Dow was up over 300 points. The dollar was down. Gold was up. Other commodities were up. And then during Powell's press conference, he backed away from pretty much all of that and even went beyond in his hawkish talk what was expected, among other things, saying that the forecast that the Fed had made in their so-called dot plot just at the last meeting in September was probably understating where they're going to go. He was bemoaning the fact that, as we've all seen in the headlines, that inflation numbers have not really come down. They're maybe plateauing, but they've not declined a whole heck of a lot in most cases. And he also suggested that, if I have my choice, I would rather overdo things and over tighten because that I can undo. But if I don't go far enough and inflation stays high and becomes entrenched, then we got bigger problems afterwards. So, during the press conference, it was not what everybody wanted to hear. And, accordingly, those initial gains evaporated and then some. We had the 800 plus point swing in the Dow. The dollar index, as you and I are recording this, 10:30 in the morning Eastern time on Thursday, the dollar index is up over 2% from what it was less than 24 hours ago. So wasn't the eventual outcome that people expected. That's for darn sure.
No, and that lends itself to the question is, when does inflation become entrenched? It's already been well over a year with these high inflation numbers. Can you not say that it's already entrenched?
Well, I think it is. They've got all these statistics they look at, and a lot of these statistics you can look at as a Rorschach test. You get whatever you want out of it. But I think it's safe to say, Mike, that a lot of people do believe that inflation is here to stay. I don't know of anybody that has half of a brain that buys the idea that the Fed is going to, in any easy way, get us down to 2%. And as I've been telling people for a year or more now, just where energy is concerned, let alone a lot of other things that we're in very short supply of, plus the geopolitical things underway, the end of a lot of secular trends for the last 40 years that contributed to the disinflation since the early 1980s. The only way the Fed gets us down to 2% inflation is if they really do crash the economy and markets and we have a depression for a while. And yeah, then for a short time, we might be down to 2% if they really crater everything, but we wouldn't stay there even in that event.
Yeah, I've been toying with the notion that the concept of the Fed pivot may not actually be in the interest rate policy. It may be in what the target inflation rate is. Instead of it being 2%, they go, well, you know what? Arguably, inflation used to be running around 4.5%, 5% historically. So that's our new target.
Well, I don't know if they'd use a number that big. After all, 4% inflation had Nixon in such a panic in the 70s that he tried wage and price controls, which failed, as some of the scuttlebutt about, nationalizing energy and putting caps on energy and doing other stuff that wouldn't work today either, because it's fighting the wrong problem with the wrong medicine, in my view, which is a subject for another day. But you're right. At some point, I think the Fed, as part of the excuse when they do finally get forced to at least pause the rate hikes, might say, well, you know what, this might not in the long term be so bad anyway. Yes, inflation's a lot higher than we wanted it to be, but look at all of the months and even a few years when inflation was 0.8% or 1.3%. And of course, those are all massaged numbers, but that's what they'll tell us. So yeah, you're right that the point will probably come where that'll be an excuse for them to maybe slow down even while inflation stays above probably whatever federal funds rate they get to.
So I'm of the belief that we're in for another 0.75% in the next meeting. What's your thoughts?
That's a coin toss. I mean, the Fed did put out, and here's one of the things Powell said that still, even though everybody was kind of gobsmacked by his, being more hawkish in his press conference than what was expected from the statement, he did still say that the magnitude of individual rate hikes now is no longer as important as the sum total about where we get to eventually. And he did say that, the level of the hike even next meeting is not set in stone. They may tighten for a little bit more and get to a higher eventual place where they paused and what they contemplated before, but it doesn't necessarily have to be that. And so I think that what you'll see, and this was the wishful thinking that we had for the last few weeks before we got to yesterday, I think, with the Dow had its best month in October, Mike, since 1976, I think it was. And it outperformed the other indices for different reasons, but that was based on the view that the Fed is getting ready to dial this down. And he didn't say that they weren't, but that simply they're going to end up at a bit higher level and stay there longer for sure, for as long as they can get away with it. So I don't know. I think it's a coin toss. You've got a couple or three economic statistics between now and then. We'll see if the market throws a year-end fit like it did in 2018, admittedly under somewhat different circumstances, but nonetheless, circumstances that caused Powell back in December of 2018 to run up the white flag. He's going to have a little bit more of a backbone this time, but if you put a gun to my head, I would say it's going to go to 50 basis points in December, just to keep the markets from really throwing too much of a fit, but that we might get a couple or 350s in a row before they quit. We'll see.
I see. So you think they're going to slow the rate, but have more rate increases. So,
Oh, he
spread the
said that.
medicine
I
out,
mean,
so to
that's what
speak.
when you look at the September dot plot, they were looking at, 4.6%, I think was the number, where by spring, the markets were sensing that would be the peak rate, at least for a while. Yesterday, after his comments, you had at one point Fed funds futures at 5.12% for next spring. That would be the eventual, and Powell essentially told you that it is going to be higher. So yeah, they'll take the, we ended up yesterday, 375 to 4 on the federal funds rate. They'll add at least 100 basis points to that, maybe 125. So when you go back to the last meeting, they weren't telegraphing much more than that. So in the end, yeah, they'll be higher by spring, but it doesn't have to be another 75 basis point hike necessarily. But, who knows? Tomorrow morning, as we're recording this, there's going to be the jobs numbers out for October. If they're not super hot, but maybe show a little bit of moderation, that'll be a nod in the direction of going to 50 next month.
Yeah, there's definitely a number of factors outside the Fed's control coming on the horizon. Also next week, you guys have your midterms.
Right.
That's going to have a definite play on all of this, as government policy has been a huge contributor to some of the inflation numbers. What's your thoughts on
Well, it has
that?
been. I think that a lot of people, part of the reason, in my view, for the rally that we had into the Fed meeting was not only because of the view that we were going to get some carrot dangled in front of us that the Fed is getting ready to slow things down, but also with the idea that some of the markets have that the Democrats are going to suffer what possibly an epic defeat in the midterms, and the Republicans to take back both the House and the Senate. The idea being, at the very least, that some of the damage financially from some of Biden's policies might be less. So all else being equal, and look, a lot of times I don't give the Republicans a whole lot more credit than I do Democrats. I'm an equal opportunity offender. I'll criticize both. If we're talking about just covering facts and common sense and let the chips fall where they may. But clearly, when you look at the attitude here right now, the markets, all else being equal, would respond well to the Republicans getting both houses next Tuesday. And I think that the odds have tilted in favor of that.
To play devil's advocate, what if we end up with a split situation where the Republicans take back the lower house and the Senate remains divided at 50-50? Then what?
Well, it's hard to say. Some of what the Republicans very much do need to do is to go, whether you're talking about Hunter Biden's involvements with China and Ukraine, and Joe Biden's acquiescence to some of these things, all of which got swept under the rug in the last presidential election, to make sure it wasn't a negative for Joe Biden. Whether you're talking about the fact that this country has an ongoing invasion of it through our southern border, and a president who has done nothing but to encourage that, and any number of things I can talk about, there needs to be some accountability for what has gone on. If Republicans take both houses, there will be a major push for investigations, possibly an impeachment. After all, turnabout is fair play. Anytime that Donald Trump sent out a mean tweet, the other side wanted to impeach him. So there will be that inclination. Now, you've got establishment rhinos like Mitch McConnell and some others that will push back against that. And along with the Democrats and the establishment media will say, well, look, let's not be vindictive. Let's try and work together since we have divided government, blah, blah, blah. So I don't know. In order for any of that to happen, the Republicans ideally would have the House and the Senate both, because, of course, if you're of a mind to do any impeachment hearings in the House, you're wasting your time, because you'll never get anywhere in the Senate. So because that's where the trial would be, if there is one. So, I think that people, aside from the politics and the jockeying for revenge or for investigations, or however you would want to characterize it, Mike, I do believe that when it comes down to just bread and butter economics and things that the markets are concerned about from the economic and investment standpoint, the least that we can say is that the Democrats will not have free rein anymore to do further harm. Perhaps you will get targeted investigations of someone like a Deb Haaland, the Interior Secretary, who's done terrible harm to this country's energy and critical metals independence, largely because she lied so many times about what her intentions were when she was confirmed by the Senate. There's the first one that should be impeached, in my opinion. So if Biden and his crew are able to do less harm to our economic standing, energy independence, and so forth, that alone will be a positive. And I think the markets will sense that. And again, the Fed could still throw a couple of more turds in a punch bowl. But if you looked only at that issue in isolation, and if I'm correct, the Republicans do get both the House and the Senate, all else being equal, stocks will rally and commodities may rally.
Yeah, I'm looking for a commodity rally, but I'm looking overseas. I am starting to become of the belief that the real elephant in the room for all of this isn't actually a Fed pivot, a US government change, but what I'm starting to refer to as the China pivot. China's been on lockdown for COVID, allegedly, since last spring, and their economy has been suffering accordingly. Now, President Xi is now, comrade for life over there. I'm guessing at some point that lockdown's going to end and they're going to go back to normal economic recovery. And the question I have is, given that their energy needs are so huge and they've been underwhelmed by the COVID lockdown, what happens when that demand gets back into the market, and what does that do to the energy inflation?
Well, you bring up a great point, because when you look, in the two usual suspects, of course, are crude oil, more specifically on energy, as well as the copper price. Part of the reason both of them have been weak of late have been from these on again and off again lockdowns. But China is in a world of trouble. You and I have talked about this more than once before. While the Fed is tightened and the ECB and the Bank of England and Canada and everybody else is tightened, the People's Bank of China, all of this year has been aggressively easing monetary policy, because they got the biggest debt to GDP ratio on the planet when you include public and private debt. And yet they've not allowed the economy to grow, debt-based or otherwise, to be able to service this debt. Evergrande's dollar-denominated bonds are basically been vaporized. At market price, you need a microscope to find it. They're gone. All right. And it surprises me that there's not been more global market fallout because of that, and some of the ancillary things that have gone along with that. So I think it is, now that Emperor Xi is emperor for life, and has got a game plan for a lot of things, not all of which are peaches and cream. They are going to go and take Taiwan at some point. We're going to be powerless to stop them, though we'll try. One of the things he needs to do is to bring back at least some economic activity to start servicing some of these debts again, because he's not going to take Taiwan or do anything else if the whole skyscraper of cards of their debts implodes and uncontrollably. So you bring up a great and prescient point that I think will add to the upward impetus on commodity prices when the markets have got more confidence that China's not going to stay shut down, but is going to at least attempt to get back to some growth again. But, I'm going to go you one better on that, Mike, because, and I'll be talking and writing about this in the very near future when it comes to the Fed and everything. There's a lot of pushback on what the Fed is doing, and Powell repeated this yet again yesterday, that he wants to bring demand back in sync with supply. Of course, to do that, he needs to make sure millions of people more become unemployed. He needs to cause a recession, which he a little bit more forthrightly admitted yesterday, not right out, but a little more than he has before. Well, why do we have to do that? Why cannot we have the Fed say that, you know what, I can't do anything, which Powell will sometimes say, for example, about the oil prices. I can't do anything about it, just a monetary policy. Why doesn't he put the monkey back on the shoulders of policymakers and say, look, if you people had not cut U.S. oil production by 1.25 million barrels from the peak, and if you had not further done things through the Interior Department and EPA and other agencies to discourage production and development of new projects, and had you not unleashed a Treasury Secretary named Janet Yellen on the world, of course, Powell's not going to say this, but had you not done that, and put a woman in charge of Treasury who got the job because of the view that she was going to use her post to beat the fossil fuel industry in submission. And if we had more supply, then you know what? Maybe we wouldn't have this. Of course, Powell could also say that if you had not started this proxy war with Russia and caused all this turmoil over there, but he's not going to go down that road either. So there's a school of thought emerging, and I hope it gets some traction. I'm going to do my part to give it some traction, that the supply area of this needs to be addressed. Who says that the only way out of this, other than Jerome Powell saying it, the other central bankers like Christine Lagarde, who is even more horrifying to listen to than Powell. Why do we have to put people out of work and cause a recession again to bail out the central bankers? Why cannot we have policymakers put the right policies in place so that we have better supplies of things? And then the supply is increased, and now all of this money that they created doesn't lead to so much inflation. Interesting point.
Yeah, but wouldn't that just make far too much sense? That could never happen.
It would make far too much sense, and it would more than that, Mike. It would go against, the very institutions of these central banks, which all need to be abolished. All right, because we're not going to solve this problem until they are. We're gonna have these on and off boom and bust economies, debt issues, and all this kind of thing. All of these Hobson's choices that we're given. Well, do you want high inflation? Or do you want to lose your job and be able to afford groceries when you get your welfare check? I don't think those should be the only two choices.
Well, I'm thinking that given the inability to wield back inflation, I'm thinking that a lot of people are starting to realize that the central banks are in fact pretty feckless in all of this.
You know what? Any thinking person that has followed these people for any number of years, whether it's Powell, whether it's Yellen, the ones that came before them, Christine Lagarde, and she's a horror show all to herself, and the rest of them. Yeah, the average person realizes that these central bankers have been not only chronically and habitually, but just so spectacularly wrong. These are the people that are in charge of this stuff. And look at what they've done. And let me tell you something else and get back to the supply thing again, too, since a lot of our listeners are interested in natural resources. And I've said this in a couple of contexts previously, and I'll continue to say it. Jerome Powell has done even more harm to our future than the average person understands. And I'll tell you why. And it gets back to this supply subject that I just mentioned. We all know, and we've all read, that we have chronic shortages and underdevelopment for years into the future of all of these different things that we need for the green economy, whether it's copper, whether it's nickel, whether it's lithium, whether it's traditional energy. And so we're ready to be weaned off of that, all of the above. Okay. And these things take a long time to permit, to explore, to develop. There's been lots of roadblocks put up in the way, which is why we're short of all of these things, plus a lot of poor planning. And now what we've added to this mix is, even when you get to a place, Mike, where you have XYZ company ready to unveil this big copper project, they've done the drilling, you got the PFS, you've got all of this kind of stuff, all the economic studies, you got your permits. Now you need to fund it, right? Well, in order to fund these things, some companies sell stock, some bring in a deep-pocketed major to bear at least some of the cost of development or whatnot. But inevitably, lenders and investors are going to make decisions on funding these projects so that they can be built and start producing and provide the copper and nickel and lithium and everything else that we need. And what this just incredibly destructive man, Jerome Powell, has done is to take any kind of certainty away from these would-be financiers. Because when you've got to commit to money for something for X number of years, you don't know if this crazy bastard is really on a suicide mission, and he is going to cause another 2008. Which, if he does, we remember what happened to the copper and other commodity prices back then. They crashed and stayed down for a while. So if you're a lender or leading a consortium of lenders, you don't know if the copper price 2 or 3 years from now is going to be $5 a pound or $2 a pound, thanks to this guy. So
Yeah,
what are you going to do? Nothing.
well, and then there's the flip side on the company end of it that's raised their cost of capital by higher interest rates, and where inflation has been infected by both government and the Fed, your cost of actually building that mine has gone up. So your targets and your
That's right.
feasibility study are all out of whack by the time you get it all built.
Exactly. So thanks to Jerome Powell, a lot of entities, which if we had some stability in the markets, in commodity prices and so forth, not this crazy yo-yo that Powell gave us, a lot of those would-be financiers, and I don't blame them, are going to be sitting on their hands.
Yeah, well, as always, it gives us plenty to talk about. Now, you've got a number of reports that are either out or coming out soon. Tell us more about those.
Well, yeah, I mean, this is a really challenging time. We're dealing with things in our lives that we've never dealt with geopolitically, financially, and otherwise. But several days ago, I put out an issue on precious metals entitled "This is Not Your Father's Gold Market." It explains how you understand and need to navigate this market properly, not with all the conspiracy theories and scare tactics and nonsense that unfortunately permeates precious metals scuttlebutt out there, but just looking at things common sense wise. So that's out. There are several examples in it of companies I recommend and the reasons why I recommend them. About the time people are listening to this, I'll have finished the editing of the second of these special reports. The title is The Art of Finding Story Stocks in a Bear Market, where I go beyond resources and I'm looking at biotech stocks, all kinds of really, really fun, cool stories. It's a great issue. I had the room packed, people standing when I gave this presentation at the Orlando Money Show a couple of days ago. That's going to be out imminently, and neither one of those will cost you a nickel. They're free of charge if you want to see those, and a couple other ones following it, and including, as we've talked about today, some video tutorials I'm going to have on just money in general. Why are we in this mess? Why do we have a Fed? Why do we have a Fed that gives us these Hobson's choices of outcomes? Why can't we have certainty with commodity prices? Why can't we have greater supplies of things? All of that's going to be addressed too. So, you can buy a subscription and membership to the National Investor, get all my individual recommendations, but I make these kinds of things available free of charge to educate people, and so that they know when they do pay up for a paid membership, they know they're getting something good. So to get those, just drop me a line, chris@nationalinvestor.com, or go directly to my website, nationalinvestor.com, and sign up.
And if they want to follow you on social media?
Yeah, the best one is Twitter. That's where I do most stuff. And my handle on Twitter is @NatInvestor. So instead of national, just Nat, N-A-T, Investor. And you can follow me there on Twitter.
Wonderful. Thanks very much for joining me today. That's been quite an enlightened talk about the Fed and their recklessness. And as events warrant in the next few weeks, and there's going to be lots of events, we'll circle back to each other and talk about policy further.
Sounds great. Thanks as always, Mike. Great job.
Wonderful. Thanks for joining me, Chris.